So this is the summary of the derivative accounting that you learned so far, and you also learned at the beginning that there are several reasons why a company can invest in different derivatives. One of the major reason is speculations, that the company can predict that the stock price may go up or down. So instead of purchasing those stocks, the company can invest in call or put options. So call and put options are examples for speculation. And when you do the accounting, you have to record the call and put option values on your balance sheet based on the fair values, and depending on the changes in those equity price, you will also record unrealized holding gain or losses. And remember, this speculation related unrealized holding gain or loss will be in your income statement, and it's not hedging, so there is no other item related or the hedged item here. Now then, we learned about hedging, and there are two hedgings. Fair value hedgings, that means to protect the negative impacts that may related to the fluctuation in fair values, and you also record this based on the fair values, and holding gain or losses will be recorded in the income statement. You also need to record the hedged item at their value, fair value, and gain or losses will be also recorded in the income statement. And you also learned one example, put options. Usually those are used to hedge inventory. If you learned it from one of the lectures, that the example of the tire inventory and how rubber price is used as an underlying, and put options to protect the value declining on that inventory. Now we also learned the cash flow hedging, and the example you learned. And cash flow hedging, a future contract is used to hedge the forecasted purchase price, for example the aluminum price and can manufacturing company. And you also learned how those are recorded as per the fair values. We also calculate unrealized holding gain or loss, but remember, this unrealized gain or loss from the cash flow hedging will be recorded under the stockholders equity part on your balance sheet under other comprehensive income, and it is not a part of your income statement, but later we reclassify as your unrealized holding gain or loss, and we use that to offset the other gain or loss related to these cash flow fluctuations. So now here we will see one comprehensive example of hedge accounting, and very interesting example, interest rate swaps. And companies usually use this interest rate swap or foreign exchange rate swaps very frequently. If there is any company who is doing businesses with other foreign firms and may receive any payment in foreign currency, or need to pay any payment, make any payment in foreign currency, they will go for foreign exchange rate swap. Or you will also see frequently when companies issue bonds and they need to pay a fixed rate, but if they think that the market interest rate may fluctuate and that will impact on the bond price, they can also do interest rate swap. So let's see the comprehensive example of interest rate swap. But before that, what is a swap? A swap is a transaction between two parties where one party makes a promise to make a payment to the second party, and the second party also makes a promise to make a payment, but both parties' payment will be based on different criteria, but that for the same thing. For example, here interest rate swap, one party may agree to pay interest based on a fixed rate, the other party will agree to pay interest based on a floating rate. For example, LIBOR is one of the common floating rate, or any other floating rate that changes, or market rate. The way it works is that different parties have different perceptions, and based on that they will go into the contract and they will both try to reduce the fluctuations or the variability that they want to avoid. So now let's see one example. Assume that Jones Company, they issued bond, $1 million 5-year 8% interest rate. So on that day, January 2nd, 2025, this is regular bond issuance. They received cash from the bondholders and they credited bonds payable, and they will pay 8% interest fixed rate. Remember, bonds interest payments are fixed. But now here, Jones need to pay fixed interest rate, but he's concerned that if market interest rate declines, the fair value of the bond or liability will increase. Because how we actually calculate it, it's the discounted factor of the all those interest payment, and if actually interest rate declines, the liability amount will increase, the company will suffer a loss. So to protect against this loss or the fluctuations or decline in interest rate, Jones entered into a 5-year interest rate swap contract, and this contract condition is that Jones will actually pay the other counterparty who signed the contract, swap contract with Jones. Jones will pay this counterparty a variable rate. On the other hand, Jones will receive a fixed rate. So first, Jones issued bonds and paying a fixed rate to the bondholders. This is fixed. Jones has nothing to do with it. But now what Jones is going to another contract, here Jones will receive fixed rate 8% and Jones will pay whatever the variable rate is. So ultimately what Jones is receiving, which is the fixed rate, Jones is also paying the fixed rate to the bondholders. So the same thing what he is receiving and paying. On the other hand, Jones is paying to the swap counterparty a variable rate. So now through this swap contract, Jones is ultimately converting this bond interest payment actually a variable rate. So this is how swap allows Jones to exchange the interest rate from fixed to variable rate. Now we will see how Jones will record those. Now assume that Jones enters into the contract on January 2nd and there is no other specific price involved or value involved. So on that day, Jones will record nothing. Now at the end of 2025, Jones need to make the interest payment to the bondholders based on that fixed rate. So this is the journal entry. Jones is paying interest to his bondholders, debit interest expense and credit cash. Remember, the total amount of bond is $1 million, 8%. Now, because of that swap contract, Jones found at the end of 2025 interest rate declined and current interest rate is 6.8%. But now remember, Jones had this contract with other party. So the contract was that Jones will receive 8% fixed rate interest that he received, and Jones is supposed to pay based on the variable rate. So Jones will pay based on 6.8%, which is the variable rate. Jones will receive at 8%. So ultimately, Jones here receiving 1.2% right here. So how Jones will record that? So if we take this difference, you can use the entire denominator, what you are receiving, which is 1 million multiplied by 0.08, and then you can subtract the total amount what you are paying, 6.8% multiplied by 1 million, and take the difference. So from this swap counterparty, Jones is receiving $12,000 and he's using the same account interest expense. So now here you will see that because of this gain that Jones is actually making, that will help to protect these fluctuations that Jones is supposed to face because of the interest rate decline. Now, on the other hand, Jones found that the interest rate swap value increased and it's now $40,000. Jones will record this entry at the end of the year, swap contract debit 40,000, and unrealized holding gain or loss, it's an income because of the swap value increased, will record $40,000. Now remember, Jones already have some bonds, and because of the interest rate declines, the bond value will go up, the liability will go up, and Jones needs to record the loss related to that bond. So Jones will record this journal entry, right? This journal entry is because of the bond value and the loss, then the bond payable value is increasing and the loss Jones is facing. So Jones will debit unrealized holding gain or loss 40,000 and then credit bonds payable. So now here you will see the ultimate impact on Jones' financial statement. Here Jones on his balance sheet, because of swap value went up, Jones will record swap under the current asset $40,000. On the other hand, interest rate declines, the bonds value increased, Jones bonds liability or bonds payable increased also by 40,000. So basically, ultimately on his balance sheet, it's kind of offsetting out. This swap value is offsetting the bond price that is increased, the liability portion. You will also see that interest rate related gain or losses are also offsetted here on the income statement. So Jones's interest expense was 80,000. That's what Jones paid to the bondholders. And from the swap counterparty, Jones received a net $12,000. So ultimately, Jones' interest expense is $68,000, and that is based on the variable rate. On the other hand, Jones has that unrealized holding gain or loss Jones recorded because of the swap value increased, and this is actually offsetting the unrealized holding gain or loss that Jones is facing because of the increased value of the liabilities or bonds payable. So ultimately, these unrealized gain or loss are offsetting each other, swap related gain or loss and bonds payable related gain or loss, and at the end Jones ended up with the interest expense at variable rate. That was Jones' intention. This is how, using the swap contract, converted ultimately the fixed rate bond into a variable rate interest rate expense.